In 1990, the average UK house cost around 3 times the average annual salary. Today, that number is closer to 9 times. In London, it's over 12. Nobody announced this change. There was no policy, no vote, no moment where the country collectively decided that homeownership should become a privilege instead of a milestone. It just happened quietly, gradually across 3 decades, and by the time most people noticed, the gap had already become a wall. For most of the 20th century, buying a home in the UK was uncomfortable but achievable. You saved, you sacrificed, you got the keys. That social contract is now broken for an entire generation, not because they spend too much on coffee, despite what some commentators would like to believe, but because the mathematics of the market have fundamentally changed. The average first-time buyer in the UK is now 32 years old. A decade ago, it was 29. That number is moving in one direction only, and it isn't moving slowly. The question worth asking is not whether the housing market is broken. The real question is how it broke, who benefited from it breaking, and why the mechanisms keeping it broken are so rarely discussed openly. To understand the crisis, you need to understand what a house actually is in the UK economy. For most buyers, it's a home. For a growing class of investors, landlords, and pension funds, it is an asset, one that reliably increases in value precisely because supply is restricted. Here is the core tension. A house cannot simultaneously be an affordable home and a high-performing investment. The two goals are structurally opposed. When prices rise, homeowners celebrate. When prices rise, first-time buyers fall further behind. The UK policy environment for decades has consistently chosen the first group over the second. Planning restrictions have kept new housing supply artificially low since the 1940s. Successive governments promised to build more homes. Successive governments failed to build more homes. Between 2010 and 2020, England built roughly half the homes economists estimated were needed each year. The gap between supply and demand didn't close, it widened. Meanwhile, low interest rates between 2009 and 2022 flooded the market with cheap mortgage money, which didn't make homes more affordable, it made them more expensive. When borrowing is cheap, buyers borrow more. When buyers borrow more, sellers charge more. The benefit of low interest rates was absorbed almost entirely by higher house prices, not lower monthly payments. Here is what the numbers actually look like right now. The average UK house price sits at approximately £280,000. The average UK salary sits at approximately £35,000. To buy that average home with a standard mortgage, you need a deposit of around £56,000, that is 10%. Saving £56,000 on a £35,000 salary after rent, bills, food, and transport would take the average person over a decade of saving every single month without a single unexpected expense. That's the optimistic scenario. In London, the same calculation stretches to 20 years, and this is before the cost of higher interest rates, which have pushed monthly mortgage repayments to levels that now rival or exceed rent in many parts of the country, removing the last remaining financial argument for buying over renting in the short term. The public narrative around this crisis has been frustratingly consistent. Young people are blamed for spending habits. Avocado toast became a cultural shorthand for an entire generation's supposed financial irresponsibility. The implication was clear: if you simply stopped enjoying yourself, the deposit would materialize. While wages grew by roughly 150% over the same period, the gap is not a lifestyle choice, it is arithmetic. The people who built wealth through home ownership in the 80s and 90s did not do so because they were more disciplined. They did so because they arrived at the right point in a cycle that has since closed behind them. The consequences of this extend beyond personal frustration. When a generation cannot build housing equity, they cannot build intergenerational wealth. The gap between those who inherited property or received family deposits, called the Bank of Mum and Dad, now the UK's ninth largest mortgage lender, and those who did not, is becoming one of the most significant drivers of inequality in the country. Not income inequality, wealth inequality, the kind that compounds across generations and becomes structural rather than circumstantial. Rental costs consuming an ever larger share of income means less money flowing into savings, investments, and local economies. The housing crisis is not a housing story anymore. It is an economic story with consequences that will play out for decades. Governments know how to build more homes. Economists know how to rebalance supply and demand. The solutions are not complicated or unknown. What is complicated is the political calculus, because the majority of voters in the UK are homeowners, and homeowners do not vote for policies that reduce the value of their largest asset. So the crisis continues, not because nobody knows how to fix it, but because fixing it would require asking a generation that already won to give something back. And so far, nobody in power has been willing to have that conversation. Maybe it's time to start asking why. If you think the housing market is broken, like this video, if you think it can be fixed, comment below. Either way, subscribe, because this conversation is just getting started.